Have you ever heard the saying, numbers are a universal language? Well, in the world of finance, that language is IFRS. And today, we're unlocking the secrets of IFRS 1, the standard that acts as a financial Rosetta Stone for companies making the big leap to international financial reporting standards. It's not just a set of rules, it's a guide to transforming your financial history into a transparent and globally understood story. So, what is the core objective of IFRS 1? It's all about providing a clear roadmap for any company that's preparing its very first set of financial statements in full compliance with IFRS. The standard ensures this inaugural set of financials is of the highest quality, that it's transparent, comparable, and provides a strong foundation for future reporting. It's a tool for consistency and clarity. Who is a first-time adopter? It's any entity that presents its first annual financial statements explicitly in compliance with IFRS. This includes companies that have previously used a different set of accounting standards, those that have never prepared financial statements before, or even those whose recent statements didn't explicitly claim IFRS compliance. Here's the most critical principle of IFRS 1, retrospective application. This means you must apply every single IFRS standard as if you had been using them from the beginning of time. Think of it like this: your transition date is the starting point for your new IFRS journey. You must go back and restate your opening balance sheet and all comparative periods as if they were always IFRS compliant. The goal? To create a seamless, consistent history free from the distortions of changing accounting policies. So, how do you do this in practice? It's a four-step process. First, select your transition date. This is the beginning of the earliest period for which you will present full comparative information in your first IFRS financial statements. Next, prepare an opening IFRS statement of financial position. At this transition date, you must create a balance sheet that is fully compliant with all IFRS standards. Third, recognize and adjust. The difference between the previous accounting standard and the new IFRS figures is recognized in retained earnings on the transition date. Finally, restate your comparative periods. All financial statements from prior periods that you present for comparison must be restated to comply with IFRS. While retrospective application is the rule, IFRS 1 recognizes that sometimes it's impractical. That's where mandatory exceptions come in. These are rules you must follow. For instance, you can't retrospectively apply the derecognition requirements for financial instruments. On the other hand, IFRS 1 offers voluntary exemptions to ease the burden. These are choices you can make. A popular one is the deemed cost exemption for PP&E, where you can use an asset's fair value on the transition date as its cost, rather than having to trace its full historical cost. To ensure full transparency, IFRS 1 requires extensive disclosures. You must provide a reconciliation of equity from your previous accounting standard to IFRS at both the transition date and the end of the last period presented. You must also provide a reconciliation of total comprehensive income. These disclosures are crucial for helping stakeholders understand the financial impact of the transition. So there you have it. IFRS 1 isn't just about a change in numbers, it's about a change in mindset. It's a strategic decision that enhances the quality, comparability, and transparency of your financial reporting. It's the essential first step to speaking the global language of finance. Thank you for watching. If you have any questions, feel free to leave a comment.